Ladies and gentlemen, good day and welcome to the Manorama Industries Limited Q4 and FY25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star then 0 on your touchtone phone. I now hand the conference over to Mr. Hiral Kenia from EY LLP. Thank you and over to you, sir.
Thank you, Steve. Good morning, everyone. On behalf of Manorama Industries Limited, I welcome you all to the company's Q4 and FY25 conference call. To discuss the performance of the company and to answer your questions, we have with us the management team comprising of Mr. Ashish Saraf, Chairman and Managing Director, Mr. Ashok Jain, CFO, Ms. Ekta Soni, AVP Investor Relations, and Mr. Deepak Sharma, Company Secretary. Before we proceed with this call, I would like to draw your attention to the fact that today's discussion may contain forward-looking statements that are subject to various risks, uncertainties, and other factors, which will be beyond management's control. We kindly request you to bear in mind that there might be uncertainties when interpreting such statements. Please note that this conference is being recorded. We would now start the session with opening remarks from the management team. Afterwards, we will open the floor for an interactive Q&A session. I would now hand over the conference over to Mr. Ashish Saraf for his opening remarks. Thank you and over to you, sir.
Thanks, Hiralji. I heartily welcome everyone to Manorama Industries Q4 and Financial Year 25 earnings con call. We continue to display robust growth momentum in the operational performance along with profitability during Q4 and Financial Year 25. We have achieved the financial guidance for Financial Year 25 by recording revenues of INR 771 crores, thereby registering a strong growth of 69% year on year. This was led by strong market demand for a diverse range of specialty butters and fats, and with economies of scale coupled with higher volumes led by commercialization of a new fractionation facility. As global awareness of environmental issues and responsible consumption rises, industries are pursuing sustainable alternatives to conventional practices. The specialty butter sector is vital for luxury chocolates, confectionery, and personal care and cosmetic industries worldwide. With an increasing societal focus on eco-friendly and ethically sourced products, the demand for sustainable solutions in this niche market is growing rapidly and significantly worldwide. We leverage our capabilities to meet the rising global demand by providing customized solutions for our esteemed partners in the food and personal care industry worldwide. Our integrated production capacities, backed by various domestic and international certifications, ensures consistent high quality that meets the strictest quality and environmental industry standards. Our research and development team has made notable progress in extraction technology and broadened our product range. We have developed new products during Financial Year 25, which includes all-round filling fats, baked stable filling fats, water cream filling fats, frozen dessert applications, and premium filling fats for new customers, along with tapping new geographies. Additionally, pursuing industry leadership, we have established strategic global subsidiaries in West Africa, the UAE, and Brazil for strengthening our global market presence. We continue to strengthen our leadership status in India with the commercialization of the 25,000 tons new fractionation capacity in the beginning of Q2 Financial Year 25, taking the company's overall fractionation capacity to 40,000 tons per annum. Highlighting our fractionation capacity utilization during the year, the existing 15,000 tons fractionation facilities capacity utilization stood approximately at 100%, whereas the 25,000 tons new fractionation units capacity utilization for the full year stood at around approximately 40 to 50%. Combined capacity utilization stood at approximately 62.5% for full year 25. Going ahead, the combined capacity utilization for financial year 26 is projected at nearly approximately 75 to 85%. We anticipate achieving greater operational efficiencies and cost optimization through improved utilization of our new fractionation capacity in financial year 26. We are eyeing to achieve INR 1,050 crores top line in financial year 26. Our capex plan, which includes several forward and backward integration projects, is under advanced drawing and planning stage. We will share a comprehensive report on this project, detailed financial plan with our esteemed shareholders through exchange filings once our management board approves going forward our capital expenditure plan. We prioritize ethical practices and environmental responsibility, aligning with ESG goals while maintaining strict standards of traceability and sustainability. Our continuous investment in research and development will foster innovation and address our customers' changing needs, positioning us for long-term success and thus delivering value to our valued stakeholders. I would now like to invite Mr. Ashok Jain, our Manorama CFO, for his comments on Q4 and financial year 25 performance. Thank you.
Thank you, sir. Good morning and warm welcome to everyone to Manorama Industries Q4 and financial year 24-25 earnings call. Highlighting the company's financial performance for the financial year 24-25, Manorama Industries revenue during financial year surged by 69% year-on-year to INR 771 crore, owing to higher demand of company's product portfolio in both domestic and export markets. The company's export business contributed 73% of total revenue and balanced revenue share from the domestic market. The company's EBITDA grew by 1.6 times year-on-year at INR 191 crore in the financial year 2024-25. Additionally, despite of 15.4 crore rupees attributed to provision of ESOP, Manorama Industries EBITDA margin expanded by 870 basis points year-on-year at 24.8% in the financial year 2024-25, which is attributed to efficient cost management and operating leverage. Profit after tax during the financial year 2024-25 surged by almost 2 times at 112 crore rupees. Profit after tax margin expanded by 576 basis points year-on-year and 14.5% for the financial year 24-25. The company's board has announced a final dividend of 0.6 paisa per share, that is a 30% of face value of INR 2 rupees per share for its shareholders. Highlighting CAGR of our financial year from 2021 to 2025. Manorama Industries revenue, EBITDA and PAT has registered a CAGR of 40%, 53% and 66% respectively. CARE Rating has upgraded the company's bank facility to A from -A. The company's balance sheet reflects robust strength with manageable net debt to equity ratio of 0.832:1. The strong ratio, that is ROE is 24.3% and ROC is 33% for the financial year 24-25. Additionally, we have trimmed out our working capital days from 180 days to 150 days for the financial year 24-25 with efficient working capital management. Our peak working capital requirement is behind, and incrementally it will be keep improving from here. We are making all efforts to our inventory management, which will help in positive outcomes going forward. Going forward, our endeavor is to reduce the net debt from here on, highlighting the net debt position in detail. The net debt stands rupees 380 crore on 31st March 25, mainly comprised of working capital loans. Our total inventory as on 31st March 25 stands rupees 549 crore, which includes raw materials, finished goods, and other byproducts. Thank you for listening to us patiently. We now open for the floor for question and answer session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nitin Gosar from Bank of India Mutual Funds. Please go ahead.
Hi team, congratulations for good set of numbers. Couple of questions. Just wanted to understand if I were to take second half margin as a guiding principle, what our business or what our plant can generate in terms of margins. Would it be fair to extrapolate it going forward? Because on the new plant, we are still running at 40-50% utilization. So going forward, if we keep improving on the utilization levels, then the second half FY25 margins that we saw are more or less sustainable and can improve from there on as well. That would be a fair understanding.
Hi Nitin, thanks for your question. So, related to your margin question, so this performance is a result of our continued focus on operational efficiencies, premiumization initiatives, and disciplined execution. So, looking ahead, while we remain confident in the structural strength of our business model and our ability to sustain healthy margins, we prefer to stay focused on operational excellence and value creation for our shareholders. And our efforts will continue to be directed towards driving consistent profitable growth, which we believe will naturally reflect in strong margin performance over time going forward.
Got it. So there is nothing like one-off in our margins, and as you keep improving on the efficiencies, it will directionally either maintain or will improve. That should be my key takeaway, right?
Yes.
Our efforts will continue to be directed towards consistent growth, sir, and we believe that we will work on this to try our best.
Perfect, sir. And one last question is, I noticed that there was a couple of commentary with regard to product-related work that we are doing. But if I were to extrapolate it and were to only see on exports part, so exports business over last 4 years has gone up by almost 4x. And if I were to incrementally think from here on, are we going to excel from here on by doing business with the same customer, by improving the wallet share, or we are also trying to grab upon new customer? As I can see, we have open new subsidiaries in UAE, Latin America, which can trigger that kind of opportunities. What should we keep in mind? How is Manorama shaping up over the next 2-3 years with regard to export opportunities?
We have a very simple philosophy in this: we have to maintain our all existing customers and continuously hunt for new customers, which we are working round the clock all over the world, including India also.
Right, but this new customer addition will not compromise our margin or ROC profile, right?
Margin and ROC profile are business-oriented plans. The customer new acquisition is different ballgame, and whether it is a new or old customer, the prices are almost approximately same.
Right. Yeah. So the call was more on, or the question was more around, we are not trying to get into new customer at a lower margin. It is not going to compromise our existing structure.
See, these are business issues. We cannot say exactly, but generally, as per Manorama's policy, we don't compromise like that. But it is all after different specifications, terms, and various ingredients in play when we supply to any customer.
Perfect. Sorry, one last bookkeeping question. Ashokji, what should be the ESOP provision for the quarter? Or maybe if you can also talk for the full year.
So full year, the total provision was 15.31 CR, and for the quarter 4, we did the provision of 3.81 crore rupees.
Got it. Thank you, team. All the best on the FY26 number as well.
Thank you.
Thank you. The next question is from the line of Rohan Mehta from FECOM Family Office. Please go ahead.
Hello, sir. Am I audible?
Yes, you are audible.
Right. Thank you so much for taking my question, and congratulations on a great set of numbers. So firstly, I wanted to ask on your working capital. Your inventory stood at about 550 crores as of March 2025. So what inventory levels are you targeting by September 2025 and also by March 2026? And while we are on working capital, also on the trade receivables, if you see your trade receivables have stood at 102 crores in March 2025, which is, more than double on a YOY basis. So are we seeing any change in customer contracts or payment terms? Could you just clarify on that?
So our peak working capital requirement is behind, and incrementally we are keep improving from here for making all efforts to our inventory management, which will help to positive outcomes going forward. So currently it is around 150 days, but we are looking forward reduce around 120 days to 140 days because we procure the raw material at the time of season. In terms of receivables, so export we receive around CAD basis and sometime advances. So we are looking forward around 30 days receivables for financial year 25-26.
Got it. And on your CBE prices, so I believe somewhere around March 2025, they were around about 5,500 tons per dollar. So have the prices moved since then? And are you seeing any contract repricing with clients?
So our average CBE prices is around 5,000 to 6,000 US dollars, because then it depends a lot of different things on specifications and the kind of terms and contracts we have with our customers. So more or less our CBE prices contracts are in the range of 5,000 to 6,000 approx USD dollars per metric ton.
Right. And on the receivables, I wanted to ask a follow-up question. So could you spend some time just explaining why has it increased? It's right now about 13% of sales, and inventory seems to be a bit of a concern because it's about 70% of revenue. So that seems quite large.
So see, you have to see our inventory in two parts. So our inventory consists of finished goods inventory also, like as we have reported our numbers, 130-150 crores of inventories of finished goods, and raw material inventories of around 400 crores. So on a financial year 25 base, if you see, it looks higher. But if you look for FY26 revenue target, then one will understand why it's higher. Because see, our raw materials are seasonally nature, so we need to have to stock it. Because since these raw materials are available only during specific harvesting seasons, and we have to procure them in bulk for our whole year requirements. So that is why if you see our projections for the coming year, turnover guidance, it won't look that high. It will look high on FY25-ish.
Okay. So I believe also on your last quarter capacity utilization versus this quarter, how much change has there been?
So on an utilization front, we can see last Q3, because existing capacity of 15,000 tons is already running on 100% utilization. And our SF2 solvent fractionation 2 capacity utilization stood at around 60% for quarter 4 approximately. So in a tonnage wise, if you see, it's a volume of 3750 metric tons from SF2 for quarter 4.
Okay. And on the receivables, you haven't clarified. Could you just provide as to what sort of normalized days we are looking at?
Because at the balance sheet date, if you see, our receivables look high. It is generally 50 days. But on an average, if you see, it is 30 days for the company as a whole. So we are maintaining that, and we are within our good terms with our customers. But on an average, if we are to consider, then you should consider 30 days instead of looking at the March FY25 numbers, which is coming 50 days.
Right. And my final question is on the employee expenses. So if you see the employee expenses, they've gone down, but we have also observed new names, in the presentation. I believe this is mainly to do with, focusing on the subsidiaries as well. So could you clarify employee expenses going forward? Are we going to see a massive jump over there?
Yeah, there is not going to be massive jump, but there will definitely be a jump if we want to increase our market share and achieve higher sales and so we will need good people to be in the company. So we can expect around 5 to 10% or maybe more jump.
Sure. That's all from my side. So thank you so much patiently for answering my question.
Thank you so much.
Thank you. The next question is from the line of Dikshi Jain from Invest Savvy Managers. Please go ahead.
Hello.
Yeah, hi.
Hi. Thank you for taking the question and congratulations on amazing numbers. So my first question was regarding a few weeks ago there was this article from Bloomberg going around regarding the cocoa oversupply of cocoa, and cocoa prices have also corrected significantly from. So how do we see this affecting our business and CBE prices?
So see, time and again we have, clarified that our CBE prices, of course, are not directly linked or related to cocoa butter, but of course somehow it indirectly relates us. But if you see our customers or the consumers have structurally changed their demand, their usage to other conventional items like CBE and other goods. So we have our own demand for CBE products worldwide, and it is growing very well. So for us also, if CBE prices are volatile, if it is going beyond a point or it is correcting for something, it is not hampering our butter equivalent prices in that way. Because structurally, the customers are changing this product, not only because of the price volatility.
Okay. So we don't see any effect of cocoa prices coming down of CBE prices, right?
So we are not envisaging that for our cocoa butter equivalent prices. The cocoa butter is a commodity and that is volatile, and we can, tag that. And CBE is a very niche product which we are customizing and, making for our customers for their tailor-made solution. So it's not that directly related.
Okay. And for CBE prices, for all the new contracts that have expired and renewed, how much price hike have you gotten for the new contracts, if there is any? And how are the prices moving for CBE?
So as we have mentioned this earlier in the call also, so average CV prices is between 5,000 to 6,000 USD dollar. It depends on a lot of factors on the specifications and terms, approximately.
But have they improved in the last few months, last two, 3 quarters? How is the price moving?
So it's like its contract is for mostly 1 year. So once we have booked the contract, for example, last year, so the contract pricings are same for full year. So there.
Hello?
Yes. So contracts are generally for 1 year and the prices are fixed. So it is not like that in every quarter the prices are changing for CV for us.
No, so what I'm asking was if any contract has renewed right now, so the new price compared to the old price, how has it moved?
Yeah. So you can take this price only for CV, 5,000 to 6,000 USD dollar. For the new contract as well.
In last 1 year, the prices haven't moved much.
Yes, approximately, yes.
Okay. And right now, CV as a percentage of sales is approximately how much?
So CVE as a percentage to sell, it is around 30%.
Okay. Are we expecting it to go up further?
Yes, we are expecting to go beyond this also in financial year.
Okay. How much are we expecting it to reach?
We can expect.
That means let's show later.
With time we can update you maybe if the quarter comes by, so we can expect that.
Okay. So one last question that I have is.
Could you please come back in the queue for further questions?
Yes, sure. Thank you.
Thank you. The next question is from the line of Jainam Doshi from Chris Portfolio. Please go ahead.
Yeah, congratulations on an excellent set of numbers. I just have two questions. One is, like, we have guided for a revenue target of around 1,050 plus crores in FY26. So if you could bifurcate the same as to how much would be volume-led and how much would be value-led, that would help us, yeah.
If you see the guidance which we have given on a top line shows the growth of around 35-40%, 36% something. So largely 25-30% should come from the volume growth and the rest 5-10% should come from the price realization growth approximately.
Okay, got it. And second is, like, we have incorporated subsidiaries in the MENA region as well as Brazil. So how big is the market opportunity there, and for which products do we see traction in such markets? And also, like, how is the competitive landscape shaping up in the American and the European markets? If you could throw some light, that would help.
No, Brazil, the Latin American market is quite huge in terms of consumption of CVE and our stearins, the value-added products. And the market approximately is projected to be around 25 to 30,000 tons. And as such, it is quite fragmented market with a huge landscape. So we see a big opportunity there. And it will take some time to build up our base there.
Okay, and the competitive landscape which is like shaping up in American and European markets, if you could guide us upon that.
So see, in world also there are very few players who are into this specialty niche business. So as if you see competitive landscape, there is so much of demand supply gap for the products. So we don't see that particular thing in the regions like that. So there is a huge demand supply gap for the products.
Okay. Got it. Thank you. Thanks a lot. Yeah.
Thank you.
Thank you. The next question is from the line of Akhil Parekh from B&K Securities. Please go ahead.
Hi, thanks for the opportunity and congratulations on a good set of numbers. In your previous comment, you mentioned that, the impact of cocoa prices volatility is not impacting CVE prices because of specific applications for CVE. Could you please highlight what are the specific applications for CBE?
The specific application as a CVs are used in food care and personal care industries, because we generally link, because in reality the pricing dynamics differ significantly and remain sustainable, irrespective of CV prices fluctuations. Because if you see the diversified raw material base for us is different for that of cocoa butter than cocoa butter equivalent.
Okay, fair enough. And in past, we have mentioned that FSSAI allows, I think, 5% of CV usage, right? And you guys also had highlighted that we are kind of far off from that number in terms of usage. Would we have that number? Where as an industry we have reached there?
5% India market.
Exactly, we cannot.
Currently, the demand for 5% is all, that is the rule if you mention chocolate on the wrapper. If they don't mention chocolate on the wrapper, then you can put 10, 20, 30%. So basically, this depends on chocolate to chocolate. Whether it is called chocolate, then it is 5%. And we currently cannot supply the whole demand, because the demand is going day by day.
So my question was, what we had highlighted was we are still not using 5% of CVE in the required products in India as mandated by FSSAI, and hence the opportunity of demand is still going to be on a higher side in coming years. So I was asking, like, where as a percentage, where have we reached basically?
That is what I am explaining. 5% is only if you mention chocolate on the wrapper. The demand is much more than that. There are many chocolates, they don't mention chocolate on the wrapper, but it is a chocolate. So the demand is much more than 5%.
Okay, fair enough, got it. And lastly, bookkeeping question, capex number, if you can highlight the guidance in terms of for next 2 years. And I don't know if you guys also kind of mentioned the volume numbers for fourth quarter and FY23. That's the last two questions.
So for the capex, like we of course will share a comprehensive report on the projects which we have announced last quarter. So because we are already on an advanced drawing and planning stage, and once our board approves our capital expenditure plan, we will share it with our shareholders on the capex front. So on the capacity utilization, we mentioned that 60% of the utilization was from our new plant in Q4.
Okay. And sorry, on capex, for additional capex, the internal approval should be good enough, or we may have to raise the debt or dilute the equity?
So we have healthy internal accruals with us, but we can confirm this only when our board approves on the financial capital expenditure plan to use. Of course, the company is having healthy internal accruals with it.
Okay. Sure. Thanks a lot, and best wishes for coming quarters.
Thank you.
The next question is from the line of Anmol Soni from Derby Asset. Please go ahead.
Yeah, am I audible? Hello?
Oh, yes, sir, you're audible. Please go ahead.
Yeah, first of all, good to see the solid growth in numbers. I have heard the guidance for FY26 about 1,050 crores. And also in the last con call, I've seen the guidance which is given is 23 to 25% for the EBITDA margin, which was almost achieved in this financial year. So my question is, I wanted to know about the margin guidance for FY26 and beyond, and how the operating leverage will kick off once we are expanding the capacity utilization in our new plants. So
sir, as we have also explained this earlier, so whatever performance we have showing is a continuous focus on operational efficiency, also premiumization initiatives and disciplined executions. Of course, we are looking ahead, and while we remain confident in the structural strength of our business model, and also our ability to sustain healthy margins, we prefer to stay focused on operational excellence and value creation for the shareholders. So our efforts will more on to continue to be directed towards consistent profitable growth, which we believe will naturally reflect in the strong margin performance over time going forward.
So the guidance will remain same of 23 to 25% of margins, or are we expecting it to improve?
Sir, we believe it will naturally reflect in the performances over time. So, and we will, keep you updated quarter on quarter basis.
Okay, sure. Thank you.
Thank you, sir.
The next question is from the line of Pritesh Chheda from Lucky Investments. Please go ahead.
Yeah, ma'am, a few clarifications. So, how much of the revenues, or let's say how much of the volume that the CBE level, because there is a value addition from styrene which has to be done up to CBE. So in our case, how much of the volume would be sold as a CBE?
So you want to know the volume sales of CBE for full year? That's the question? Yeah. Okay. Yeah. So the CBE sales for full year FY25 was 4,500 metric tons, and stearin sales were 7,000 metric tons.
4,500 and 7,000. So, okay. And your full year volume, so let's say the quarter 4 volume, you mentioned that 60% is utilization in fraction 2 capacity and 100% utilization in fraction 1. So when you do the math, the volume comes to about 2,400 tons for the quarter 4.
Quarter 4 volume will come 7,500 metric tons. So if you are asking only for quarter, not for full year.
Quarter 4 is 7,000 tons.
7,500 capacity utilization.
Oh, sorry, I didn't understand. 7.5. So your capacity is right, 6,000 fraction 1 and 6,500 tons fraction 2, right?
Yes. So our full year capacity of fractionation 1 is 15,000 tons and fractionation 2 is 25,000 tons for full year. It is 40,000 tons for full year.
Okay, understood. And the other comment was on the finished goods contract being fixed. So since you have bought the raw material for the year at the end of quarter 4, that's how the seasonality is there in your RS, and you would have a finished good pricing which is fixed, there should not be any volatility in your margin number incrementally, right? Or if there is a risk to margin, what it is?
So can you repeat your question once? Yes.
Since you have bought the inventory for the full year now at the end of quarter 4, okay, and your finished goods are on contractual pricing, what is the risk to the market?
So this is business, and business always has risk. But as such, we don't see immediate any risk perceived in the current. But business is business, sir. We cannot guarantee anything.
No, I'm asking if there is any risk to a margin number, where it can emanate from.
That you have to tell us, sir. We don't as such see any.
No.
These are natural products we are procuring from the forest-based in Africa and India. And we are making a specialty products which are being used by the top companies in the world. So business always has risk, but as such immediate risk we don't see anything substantial.
And my last question is, between the FY24 and FY25 margins, is the scale of operations a key change in the margin number, or is there any other driver for margin?
Hello.
Hello?
Yes, hello.
Yeah, ma'am, I asked a question. I said between the FY24 and FY25 margin, where FY25 is way higher than 24, is the scale of operations a key reason for the margin change, or there are any other drivers as well?
So of course there are scale of operations which is giving, attributing to the margins, but along with that, there is the volume-led growth also we has contributed. Also the product mix has changed for the company, and also there are the price growth. So there is a combined aspect, if you see, which has attributed to our margins. So it includes operational efficiency, economies of scale, leverage benefits, product mix, and so on.
What will be a product mix change between the 2 years, and what is the pricing change in the 2 years?
The product, if you see, the CBE contribution to sales earlier was around 10%. So this year it is 30%. So that is how the value-added product has been contributed. And our pricing range has been around between $5,000 to $6,000 approximately for the CBE prices.
What was the corresponding sales pricing number last year?
Last year, it was around. So we have to see what was last year pricing contract. Maybe we can take this question offline and get back to you for the last year contract. Yes.
Okay.
Thank you.
Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Kushal Goenka from Mangal Keshav Financial Institution. Please go ahead.
Hi, thank you, and congratulations on a good set of numbers. My question was, last quarter con call, we had the management had mentioned that we'll come with a full plan in the Q4, that is this Q4. But since there was no update in the presentation also and in the starting comments, so I just wanted to know if there are any delays with the backward and forward integration and the final project which is going to come in?
See, we already have mentioned that, we are already on an advanced drawing and planning phase for our products. And of course, the team has been, given the mandate to work on the comprehensive report and submit to the board, and that's how the process works. So it will take a quarter more or more, to get these things approved from our board on our capital expenditure plan. And then only it will be, feasible and will be good to share with you the outcomes of the board on CapEx going forward. So there are multiple projects we have announced in the last quarter. So we'll share the report in the coming going forward.
So can we expect in this quarter only, or by next quarter only we'll get the clarity on the same?
So as soon as we finalize it, so we will see, we are very hopeful to get all these things quickly. And we are very hopeful to start the construction also this year.
Okay. Thank you, sir. My next question would be, actually I'm like a little new to this company. I was just checking the financials of 2019-20, and that time our margins was around 28-23%, but then it again dropped to 17-14%, and again we have reached around 25% margin. So my question was, can we sustain these kind of margins for like in the next 3-4 years, or is there some volatility chances?
Yes, sir. If you see that performance of 2019, because whatever performance we have given in H2 related to our margin, it is a result of our continued focus on operational efficiencies, premiumization initiatives, and disciplined execution. So looking ahead, we remain confident in the structural strength of our business model and our ability to sustain healthy margins. So again, we are saying that we believe it will naturally reflect in the margin performances over time. Because in 2019 also, when that has happened, we have undergone a new capex of 15,000, additional 25,000 tons capex, which has, compressed the true EBITDA level margins. And now when we have started our new plants, the 25,000 plants, and the revenue is contributing to the growth and also to the bottom line. So that is how there is a difference of margin in 2019 and this year.
Okay. And during 21, 22, 23, if you can let me know what happened.
Setting up a new capex. So this capex, we nearly tripled our capacity from 15,000 tons. So that financially, if you are looking at us, and it was a COVID period also, and accordingly that margin was there.
Okay. So, now again we are doing immense expansion forward and backward integration. So won't that again hurt the margins going ahead?
So it's too early to say that, because the projects we have taken, prioritize those projects, we are giving a payback period of less than 3 years. So it's too early to say how it is going to impact our margins, but our efforts will continue to be directed towards driving consistent profitable growth for our stakeholders, and we believe it should naturally come in our performances over time.
Thank you so much. Best of luck.
Thank you.
Thank you. The next question is from the line of Maitri Shah from Sapphire Capital. Please go ahead.
Hello. Yeah, I just had 2 questions. Firstly, you said that you are going to be reducing the debt going forward. Any guidance on what the net debt will be in FY26?
So, we are doing our best efforts to reduce the net debt, and in going forward the debt will be reduced. So our peak working capital requirement is behind, and incrementally it will keep improving from here. We are making all efforts to our inventory management, which will help in positive outcomes going forward. And going forward, our endeavor is to reduce the net debt from here now.
Net debt is 350.
And then.
So the current amount of 350 crores is the peak amount we can see for now?
So currently net debt is around 380 crore rupees, mainly comprised of working capital.
And that's the peak we can see, and from here on it will go down.
Accordingly, the revenue we will generate, accordingly it will be reflect the net debt.
Okay, and the other income in fourth quarter is double what it was before. So any one-offs in the other income?
So other income includes forex gain loss also. So we have earned around total 6 crore rupees in this quarter. So other income includes forex gain loss as well as the interest on FDR. Fixed deposit receipt. So we are around 100 crore rupees fixed deposit. So every quarter we around 2.5 CR, 2.2 CR is receiving the interest on these fixed deposits. That also include in other income.
Okay. Thank you.
Thank you.
The next question is from the line of Janvi Shah from Share India Securities. Please go ahead.
Hello. Congratulations on the numbers. I just had one question. You mentioned that the margins improved because of scale of operations and product mix as well. So I just wanted if you can spend some time explaining how has the product mix changed in the last year, and which product gives us the higher margins, if you can explain.
So all our products are value added. So most value added products for us is CBE and steering. And the contribution, the way it has gone up, so the CBE sales were around 10% to sales last year. It has gone to 30% of sales to last year. So this is how the product mix has been.
Growth driver for you.
And every value-added product is contributing to the margin. So we have steering and CV and other products for the specialty fats and butter. All of the products contributing to the margin.
Thank you so much.
Thank you. The next question is from the line of Kaushik Mohan from Ashika Group. Please go ahead.
Hi, sir. Hi, ma'am. Congratulations for the great set of numbers. I just wanted to understand one thing, like with the inventory of 550 crores what we have, what can be the revenue can be converted?
So we have given you the guidance for FY26. It is around 1,050 plus crores.
Yes. So that means that the raw material, in the inventory, how much is the raw material, ma'am?
Raw material inventory is around 400 crores.
400 crores. That means that we have this raw material in the older cost, right?
Average cost.
On average cost. Perfect. And another thing, I just wanted to understand, ma'am, this year we can see that our return matrix has improved, ROC and ROE. Because of capacity utilization coming up and now 40,000 metric tons, that is also coming with 65% is what we are capacity utilizing. That will improve and operating leverage will play out in our game, right? So can we expect the margins to improve over here in the EBITDA level?
So performance what we have given you in H2 is the result of our continued focus on operational excellence, and of course our efforts will be, continue to be directed towards driving consistent and profitable growth for our stakeholders, and we believe it will naturally reflect in our margin performances over time. We can update you quarter on quarter.
Got it, ma'am. And last question from my end, ma'am. I just wanted to understand, currently we have 40,000 metric tons. Do we have any plans to put up new capacity?
Yes, sir. We already have announced 5 projects last quarter. So directionally, the company is moving toward those directions of project of forward integration and backward integration. Of course, the company is having plans for another 3 to 5 years roadmap, which we have shared with our shareholders in our last con call. You can prefer that, and once we get approval from our board on the project, and we can then share you the timelines and comprehensive report on how we are going forward with those things. And
in the total
construction to this year, hopefully.
Got it. Ma'am, and in the total output of this year, how much is CB and how much is starch? How much can you bifurcate in the value terms, volume terms?
CB and stearin is 50% of our total value-added product wallet share. So see, both the products, stearin and CB is value-added product for us.
No, in the percentage terms or in the number terms?
7,000
So you are asking the volume-wise?
Volume-wise.
7,000 ton is the stearin and around 4,500 ton is the CB. Both are the value-added products.
So it is like
that is for the quarter, right?
For whole year.
For whole year. So we are giving you data. Okay. So percentage-wise, 20% is CBE in the volume and 30% is stearin, volume-wise.
Perfect. Okay. Thanks. I'll get back in this.
Thank you, Kaushik.
From the line of Mayur from Wealth Managers, please go ahead.
Good morning to the management and congratulations on a very good set of numbers.
I'm sorry to interrupt, Mr. Mayur. Your voice is coming a little low. Can you speak a bit louder?
Yeah. Congratulations to the entire team of management. Now is it okay?
Oh yes, sir. Far better.
And congratulations to Mr. Saraf and the senior management for driving the transformation of the company. That's great to see the kind of transformation over the years. So hearty congratulations. I had just a couple of questions. Some clarification first. You said on an annualized basis, annualized means FY25, not Q4 annualized. I'm saying overall capacity utilization on 40,000 tons was close to 60%, right? So our volumes were closer to 24,000 tons on an annual basis. Will it be right way to understand?
So it will be close to 22,000 tons because we started new capacity in July 2024.
Okay. And so CBE by volume was 20%, and we say 30% by way of revenue.
Yes, right. Correct.
Okay. And similarly, overall value-added products on this 22,000 tons would be 50%.
Yes, tonnage-wise.
Tonnage-wise. Okay. And by revenue, will it be much higher?
Okay, it should be close to around 70%.
77. Okay. And
70%.
Okay. Given that we are in a rising commodity base commodity prices, which in terms of cocoa butter, the pricing is on the higher side. It's rising trend. Will it be fair to say that there can be a tactical way to play the spot market as well as the contract market. I mean, so how much of our currently is contract sales, long-term contracts in the sense 1-year contract, and how much is sales? Can this mix change based on what we think is right currently in the market, and how does it play for the next year?
These are our super specialty niche products, and they are used in the various chocolate industries all over the world. And they mostly are on yearly contracts. Therefore, in case of some of our customers want immediate delivery, we may sell them on spot basis. But generally, most of the contracts are on long-term basis.
Okay.
So basically, commodity or this is not a. Then these products are used in the various serious food applications, especially the chocolate industry. So these all are mostly on planned basis so that their factories don't stop. They continuously receive the materials. Maximum business is on the long-term contracts.
Long-term contracts. Okay. So, sir, then in that case, given the significant rise in the prices, sometime in the next year, maybe H2 of next year or sometime closer, shouldn't we see a decent rise in our contract pricing as we go ahead? I understand it will be gradual, but from a $5,000 to $6,000, not specific I'm asking, but at a weighted average level, we should see a decent rise as we go ahead, as conceptually, right?
It is the cocoa butter is a commodity. It will go up, it will come down, it will then go down, it will go up. That will keep happening. CB is a specialty, and we have these long-term relationships with all the chocolate majors of the world. So we have to be sustainable and be a dedicated supplier to them. So this is not based on any. This is not a commodity we start taking advantage or disadvantage. It is a joint business because there is a very who will give the service of the collecting from the forest and making those specialty products, and then eventually they are being eaten by the most population of the world. So this is basically more sustainable, stabilized business rather than a commodity business model.
That's great to hear, because it then tells the nature of competitive advantage or moat for us, that it is more sustainable as we go ahead. That's great. Sir, another aspect was as we go ahead, Manorama being an integrated player, we have ethical sourcing, we have strong relationships with on the sourcing side in two of the markets where the raw material is there. What would be the positioning of Manorama globally for us currently in terms of overall global position, and do we think that we can be among the top leaders as we go ahead over the next couple?
I think we are already in the top leaders because there are hardly 3-4 players in the world, and we already are there, and we are every day we are going from strength to strength, and we are getting huge recognition, not only the awards, but many strong recognitions. Big companies are depending on us for the supplies, and this is a very, as you rightly said, this is a very niche business. This is not any easy business. You have to collect the raw materials, make them into the world's finest products, which are eaten by the children of not only India but of the Japan or America, Latin America, Europe, Russia, everywhere. So we are already, I think, there, and we are the only company in the world who makes from mango, from shea, from sal, who has all these products in one basket.
Right. And
I'm sorry to interrupt, Mr. Mayur. I would request you to please come back in the queue. The next question is from the line of Apurva Singh from Pancharatan Investors. Please go ahead.
Hello, am I audible?
Yes, sir. Please go ahead.
Yeah. Thanks for giving this opportunity and doing this con calls. This really helps investors like us. And all the best congratulations for the numbers. The question I wanted to understand was, I wanted to understand the growth of the CV contractual prices. If that is not available, I would want to maybe get back later on that. Could you give some idea on how has that grown, the CV contractual prices?
CV contractual prices are ranging approximately between $5,000 to $6,000. It depends on the specifications and terms with the customer.
How has that grown now in the last 3 years? I wanted to understand that pricing.
They're growing in a relative manner as per the increasing demand and the usage of the eating of the chocolate by the human population in various geographies around the world.
So we don't have a current number on how that has grown in the last couple of years?
They are growing substantially year by year. There are various factors and demands based on the demands in various geographies. They are growing. As such, we don't have a specific number.
Got it. Also, second question is that what is the price sensitivity of cocoa versus CBE prices? If you can give an example in terms of, let's say, if cocoa is priced at 100, what would be a cocoa butter equivalent prices be?
Cocoa butter equivalent prices we just mentioned you, $5,000 to $6,000, and cocoa butter prices is volatile that we can track online is approximately around $20,000 as of now, and it's a commodity. We can track this also prices in Google.
Got it. But just wanted to understand, is there any correlation between that? Like, what is the price sensitivity? If it is 100, then what is the kind of in general industry standards of cocoa butter equivalent?
If cocoa butter is around $20,000 or roughly around $14,000-15,000, so it is not directly correlated, but of course in a way indirectly it is. But as such, then the CV prices should also be in the same range. So basically there is a vast difference. CV is more used in the chocolates for the compatibility and for other reasons. It is not right to assume, but there is a pricing dynamics differ significantly.
Got it. Also, the last question is that just wanted to understand the contracts we have. What are the price renegotiation clauses, if any? Just if you can give some idea on that, because you say we have long-term contracts in terms of 1 year. So, any special cases where these contract price renegotiation can happen? Any clauses on that?
There are big contracts. They are all we have confidentiality contracts with our all the customers, so I cannot disclose all that here.
Got it. So I don't want the confidentiality thing. I just wanted to understand what are the clauses which will lead to renegotiation so that those factors could be tracked as an investor. But thank you.
No, but there are various, these are the gods of the chocolate multinational companies of the world, and all the contracts have, it is as per the business terms, it is decided.
Thank you. Okay. Congratulations for the numbers. That's it from my side.
Thank you.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question for today's conference call. I would like to hand the conference over to the management for closing comments.
I would like to extend my gratitude to all the participants for dedicating their precious time to join us for the Manorama Industries Q4 and Financial Year 25 earnings conference call. The company continues to solidify its reputation as a dependable and leading provider dedicated to fulfilling the increasing needs for sustainable cocoa butter equivalents, specialty fats, stearins, and butters, and our various new product launches. With our focus on research and development, we maintain our status as the preferred supplier of specialty fats and butters to both our global and domestic customers. Also, should you have any additional questions, kindly feel free to reach out to us via email or kindly contact Ernst & Young, our investor relations advisors. I sincerely thank you all for participating in this phone call today, and I hope you have a wonderful and happy, healthy day. Thank you.
Thank you. On behalf of Manorama Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.